On today's episode of the Investing Revolution, we're going to talk about cash flow. We're going to open up a spreadsheet. We're going to dive into it. We're going to talk about how to find a cash flowing property and how to keep it making you money every month.
This is the Investing Revolution, a podcast designed to help your real estate investment strategy. On this podcast, we'll teach you the actionable steps to take and pitfalls to avoid so that your real estate investing can thrive.
Welcome to the Investing Revolution. I am your host, Jonathan Cook, and with me is my great friend, Christine Bennett, my co-host.
Hi, guys.
Hey, Christine.
So we're talking about the thing today.
Are we talking about, well, there's a lot of things, Christine.
Oh, I know.
Are we talking about the big thing?
We're talking about the big thing.
That's just cash flow. Is that what we're talking about? Are we talking about cash flow? Of course we're talking about cash flow.
It's like one of my favorite things.
Do you not think that I know that we schedule these episodes and we plan them out and I know what we're going to talk about before we talk about
it? The thing is this is the
I ruined the magic. Yeah, I know. It is the thing. I feel like every episode that we've done so far is ultimately been leading to this, right? Mm-hmm. This is like big number one. I've got a spreadsheet out. I'm looking at the spreadsheet. You have the same spreadsheet out. We're actually going to talk about, we're going to deep dive. We're going to get literally Excel spreadsheet granular and talk about finding a cash flowing property, building a cash flowing property, making sure that your property is actually cash flowing and how much that cash flow can mean. Does that sound right to you? Is that what we're going to do?
Yeah.
Yeah.
That's what we're going to do today.
Yeah.
We're going to mind blow.
Let's get into it. So real quick, let's give a quick overview. When we say cash flow, we mean the amount of monthly income your rental property is bringing in after expenses. How many expenses are there, Christine? Or is it just your mortgage?
No, baby. Yeah. It's a little bit more than that. It's a lot of bit more than that.
Yeah. There's ways to calculate this before you purchase a property to make sure that what you're buying and what you're trying to fit in a cash flow model strategy actually is there, because you can buy a lot of properties that have some cash flow, but that's not optimizing a cash flow property strategy. We're talking about optimizing this in a way that you're bringing in major cash flow. We're talking about a 21% cash on cash return. That's what we're talking about here. And at least this example spreadsheet that we have pulled up, which is actually based on a real property. Mm-hmm. So this spreadsheet that I have done was an example that actually you and I had been discussing this when we were talking about some of our own investments, right?
Yep.
Like the purpose of this is, where do we find properties? Where can we go and look and build this model with major returns for our investors and can show them a ideal version of what this is. And this was one of the properties that I had come up with. This one it's definitely not the best one. I literally targeted this one because it is the median in the area where it was at the time. It was not the best option. It was so if we optimize how the strategy works, you can even take this property, which, the address doesn't really matter, but the idea is this was a $150,000 property that is essentially rent ready at the moment. It probably needs some paint. It probably needs a little bit of flooring, some carpet, some stuff like that. But it would be cash flowing if you bought it right now. This is a turnkey property, basically. This address, this spreadsheet represents buying a property that is rent ready right now and is a cash flow property.
Cash flow positive.
Yeah. Oh, God, yes. Because you can have negative cash flow, but that's not what we're talking about today. So in a property like this, Christine, what is, all right, we've talked about C-class properties in a previous episode. To me, and now this is just my opinion on this, I seem to find significantly more cash flow optimized properties in this kind of lower income C-class area And there's been a lot of work going on in the area. There's been a lot of people that have been putting some work and some flips into some of these areas, and it's representative in those median price ranges rising up and the rent prices rising up, right?
Also the appreciation.
Yeah, absolutely. And so what we're able to do in these areas is purchase, and you know what? Let's not beat around the bush. I mean, this property was in Griffin. This is Griffin, Georgia. So Griffin is, less than 15 minutes away from where we're sitting right now in the podcast studio. It's just down the road from us. We're talking about in South Georgia, or South Atlanta, not South Georgia, the South Atlanta metro. Griffin is a really cute little town. It's an older area. The homes in that area are all built, in the 30s, 40s, 50s era. That they have a very similar look. It's all those small. Would you call that cottage style, or would you call that like a bungalow?
I would say bungalow.
Okay.
I think the key here is 15 minutes from where we are, but 30, 45 minutes from
Atlanta.
Yeah. This is a true secondary market.
Yeah.
This is just far enough to where it makes rental properties affordable for people.
Yeah.
This is basically a prime example of how you can find something in this market right now that is cash flow positive.
Yeah, absolutely.
So I want to go back though.
Okay.
Because I think our listeners really need to understand how simple this is, how simple the process is.
Okay.
So Jonathan, you geeked out. Let's go over gross monthly rent.
Okay.
What does that number look like for this property?
So, all right, the gross monthly rent on this property is $1,100. So, and the way I calculated that, there's no one direct way to find a rental value, because just like any other market, it's what someone will pay for it, right? So this area has rental properties in it reaching, $1,800 a month in a few cases. That's not prototypical. It's pretty rare that you see something like that, but the top of the market reaches around $1,800. Now, $1,100 also isn't the cheapest. $1,100 is right along with the median. This year alone, there have probably been maybe a dozen or so properties in this little small town alone that have rented between $1,000 and $1,200, right there along that $1,100 is kind of that little sweet spot. And they definitely range in quality. That the ones on the less expensive side are 2-bedroom instead of 3. They, are carpet instead of LVP.
Lower end finishings.
Yeah, lower end finishings. But the higher up you go, the $1,800 a month property, that was like a completely refurbished, refinished, looked like a era appropriate, complete rehabilitation. It was beautiful. And actually just slightly north of these areas are some brand new construction homes too. And so those are renting, upwards $1,800 and up. So that's what's bringing in the rents, and that's what's driving those rents up, along with the fact that we have several investors that are entertaining that area and creating good high quality products, which are slowly rising the rents, not over that $1,100-$1,200 a month range, but it's taking those $800 and $900 a month properties, and there's less of those for sure, but because there are much fewer properties that are in as distressed, and I don't mean distressed, but just in as low quality as possible. So it's just bringing in more money and stuff like that. But what's crazy is, like, when you look at buying a bunch of investment properties, are you looking at the economic drivers, things like that? And you're like, well, what does Griffin have in it industry-wise? There's a lot of retail and stuff like that, but it's close to Atlanta, but it's not in Atlanta. And there's tons of stuff in the Atlanta area that these people could work at. People in the Southeast, we don't mind driving 30 to 45 minutes for work.
Nope. And this is why you're going to see so many secondary markets that have a ton of properties like this. They're just far enough just close enough. And so we won't give the address, but we're talking about the gross rents. What does it cost to actually run this property? Let's really dive in.
Okay, so I don't want to jump into the first month. I mean, I have our management fees attached to this. We're just going to run into just like month 3, month 2. It doesn't really matter. It's a good example. So management fees on this $1,100 a month property is going to run you $77 at the moment. I mean, our management fees are 7%. That's what ours are. Maintenance. Well, I'm going to finish with maintenance. Is that okay? I'm going to skip that cell at the moment. We're going to look at taxes. So taxes on this property annually are $1,982. You do pay that all at once. You don't pay that monthly, but you need to divide that out monthly to truly calculate your monthly cash flow. So when you divide that out, it's $165.17. That should be viewed as a monthly expense. Your insurance. So I was using average insurance pricing in the area based on square footage. The annual insurance for this property is $626 and no cents on that one, which that divides out to $52.17 a month. Mm-hmm. And again, some people pay that annually. Some people can pay that monthly. Depends on what your structure is, and it can go up and down.
So I want to skip over the vacancy for the moment.
Okay. You just want to jump down to the loan?
Yeah, jump to the loan, and we'll talk about what debt service is and that sort of thing.
So the debt service, the loan, that's your principal and interest based on in this case, it was on a 3.5% rate, which is, I know that's changing, and depending on when you hear this episode, it may be vastly different, but at the moment when this was calculated, it was at about 3.5%, and a mortgage on this $149,000 house with a 20% down payment was $542. That's super, that's principal and interest. That's a pretty good monthly payment for bringing in $1,100. Now, are we bringing in, is your cash flow $600 a month? No, of course it's not. Is it $500 a month? No, you have to calculate all that in there. And if you're not calculating all of these, there's the reason that I break it down monthly, even for things that you pay annually. There's a reason, and I'm going to get into, do you want to talk about vacancy or do you want to talk about loan first? Or vacancy or maintenance?
So I think we should.
Because there's a reason that I have them calculated the way that I do.
Yes. I think we should let's talk about maintenance. Let's talk about what the expectation for a property like this should be for maintenance and why we chose that number. Okay.
So I have an annualized maintenance fee on this property, or maintenance cost on this property annually at $602.80. That is the actual annualized number. Does that mean you're spending $602 every single year in maintenance? No. I mean, that breaks down to $50.23 a month, which does that cover, even like a service charge? Not really. But why did I come up with $602.80? So there is a lot of calculation to this. It's based on square footage is one of the biggest issues, to be perfectly honest. And I know when you think real estate, good real estate, you're like, oh, what's the most square footage? I can get the most for rent for that. And while that can be true, if you own a rental investment, square footage can sometimes be the enemy, because if you have to paint the entire thing and you have 1,500 square feet, that's going to be a whole lot easier on your wallet than if it's 3,000 square feet, right?
This is why it's so important to plug these numbers in from the beginning. And actually, I would even argue this is something you should be doing every year. You should really sit down, look at your portfolio, look at how the property is performing, look at what you actually spent in maintenance, because we deal with this all the time.
Yeah, no, we do.
Owner calls, oh my goodness, I just spent X amount of dollars on this repair. I'm like, oh, okay. So how much did you budget for? What do you mean budget for?
Exactly. And that's why we keep reserves for certain people, but you're absolutely right. If you're not planning for it, then when it hits you, it's like, oh, it's shocking. It hurts. It's the same thing that we talked when we were discussing like roofs and stuff like that in a long-term buy and hold. You have to plan for these things. Things are going to, you own this property and you're going to have to handle regular maintenance. These properties aren't going to last forever. Nothing in a property is going to last forever. Everything has a shelf life. Everything has a half-life. We're talking about paint in general. Even if you have good quality paint, that's going to, at most, if nobody is scratching it or beating it up, it's going to last you about 7 years. Flooring, probably actually a little bit less than that if it's carpet.
So real quick. So everyone kind of understands where we get these numbers, because I know it feels or sounds arbitrary sometimes. So what Jonathan was just talking about was the notion of useful life. You know,
Correct.
How long
Yes.
do these things last?
Absolutely.
So it's one of those concepts that we share with like the insurance industry. We're just trying to gauge how to prepare these numbers.
Absolutely. And it factors into security deposits even.
Absolutely.
So when I calculate a monthly maintenance cost, or even just the annualized maintenance cost, it's not how much would it cost to repaint this house and redo the flooring if that needs to be, and what if the HVAC goes out, and what if there's plumbing issues. No, it's not that. It is, you calculate a turn cost and average out how much is a turn actually going to cost on this property. If your average lifespan on a tenant is 3 years, which that's what ours is, how much is it going to cost to turn this property, repaint, recarpet the thing? There's a number there. And then you add in additional maintenance costs on top of that for likely issues like your plumbing and little things like that. And there's an annualized actual percentage number that we use for that as well. We add it all together, divide it by 3. Now it's annualized. And then guess what? Then after you do that, divide it by 12. There's your monthly maintenance cost. Ta-da!
So you're going to find too, a lot of professional investors or investors who have a larger portfolio, it is not uncommon for them to take that guesstimate. It's an educated guesstimate on how much it's going to cost. It's not uncommon to put that in a separate reserve. And it's actually pretty smart to do that. Absolutely. Because you don't have to worry about it when it hits you. It doesn't really affect your actual cash flow numbers.
No, of course not.
And you have a little piggy bank.
And to be perfectly honest, when I am discussing an investment analysis with a client, that's the reason that I show it monthly. This is the reason that I show these things monthly, to allow them to plan and take a reserve. Every time you get this $1,100 payment, you've got to take all these things out. Even though you haven't paid $50.23 in maintenance this month, go ahead and set it aside. Maybe it hasn't cost you that yet, but eventually you're going to have to use it. Set it aside for a second. Go ahead and put it in a reserve account. It's not hard to set those up, but they are absolutely invaluable when you have them there.
Yep.
Because that's going to save you for when the inevitable, the sink is leaking. Well, a leaking sink is probably going to cost you more than $50. Let's be real. We got to send somebody out there. They're going to do some work, and it's going to cost $120, $180, $200, some number. They're going to come back with whatever fix they have. Okay, well, if you've got 4 months saved up, guess what? No worry. You're prepared for it.
So, shameless plug. This is obviously why I think it's important to have a property management company.
Gotcha.
Because vendors, contractors, they know that we generally require or prefer to have cash on hand for an owner or for
absolutely.
a portfolio. That gives us the ability to get better rates.
Yep.
Get better quality vendors. It's simply because we are reserving some of their funds so that you don't have to worry about, how are we going to get paid?
Yeah.
It's already there.
And aside from that, just to kind of piggyback on why it's important to have a property manager, is the reason that our general contractors, aside from those reasons that Christine just was saying, one of the other reasons that they give us good rates is because we give them a ton of business.
Of course.
Absolutely. So that's how I calculate maintenance. Do you want to talk about vacancy?
Yes. Let's go to this.
So vacancy that I have calculated in this, let's see, what is my actual vacancy cost on this? $550. Where does $550 come from? It's based on average days on market. Ta-da, done, easy. It's simple. It is unbelievably simple. So days on market is the time that we are marketing your property. That is We have put a for rent sign in the yard, which we don't actually do. We put them on the internet because nobody looks at signs in yards anymore. So it is being marketed on your Zillows and all your other stuff. How long is it going to take from the day that it hits the internet to the day that someone is in the property? In this area, the median days on market time frame is 15 days. Our median time on market is 9 right now as a company. But when I'm calculating this for an investor, I'm going to calculate it based on market statistics, not just our performance. Because realistically, even these maintenance costs, we could probably bring them down a little bit, because I know we can get it a little bit cheaper than this. So I average these out based on market information for the most part. When I'm looking at that vacancy, if it's going to take 15 days to lease, well, then you lose half of a month's rent. That's $550. There you go. There's your math.
So,
and that's a real hard loss, right?
It is real money that is you have no way of recouping.
It's an opportunity loss.
Exactly. So when you're looking at these numbers, it's really important to watch over the variable expenses. Those variable expenses are the two we just talked about. That is, how long is this property going to sit on the market without having a tenant or having making money, being productive? How much are we going to spend on maintenance? And maintenance is, we're going to do an entire show on maintenance specifically, but the better you plan for it and the better you anticipate it, you're going to be in a lot better situation.
Absolutely. And that's exactly right. You've got to plan for realistic numbers. If you are planning on some arbitrary number that someone told you on, some article that you read or some whatever, it doesn't matter what it is. If someone told you,
or not planning at all,
and then you start getting these expenses, and you're like, well, it's written for $1,100 a month. I was hoping to get $500 a month cash flow. Well, you have made a mistake from the start. There's no way I can overcome that. Even if I cut my maintenance cost to zero, even if I lease it in the day that it, is available, those are the only actual variable expenses. Hey, guess what? How much cash flow are you making a difference from that? So that's $100 better. You're not near 500 because the actual the monthly cash flow on this is $167.50, which that's not a crazy number, but also this is a super low investment. You're actually coming out of pocket some $30,000. Like, that's with a down payment and actually spending almost $3,000 on making it truly rent ready. That's not a lot.
It is not.
And you're making back $167 a month. That's really good cash flow. There's your 21% cash on cash return after 3 years. It's a major number. Like, it's some big dollar bills, right? And if I add 100 to that, now you're at 267. Actually, because it's not 100, it's 45 and 50, so it's it's $95. But let's say you add $100 back into that with your variable expenses. Are you to 500? No, you're not even close. You're halfway there. And that's why it's important to calculate these numbers to get a realistic idea of what this is supposed to be before you buy it.
So this right here is what separates, the investor who has 1, 2, 3, 4 properties from the investors who have hundreds of properties. Oh, yeah. And it really has very little to do with, where did they find the funding? Where did they get the money? How did this happen? It's this right here. It's looking at what you can actually make on a realistic scale from each property. And this is where you see successful growth in a portfolio. You see the positive cash flow. And then, so we'll go back to those variable expenses. You're going to find sometimes, and Jonathan, you can elaborate on this. Yep. You're going to find sometimes that you will even see larger investors put the maintenance number at perhaps 0 for most months. Yeah. And then in month 5, they have that annualized number, but it's just based on like second quarter losses, third quarter losses, because that allows them to basically set themselves up for refinancing. There's a lot of ways to kind of play with it. Oh, absolutely.
And yeah, absolutely. There are ways to enhance some of these numbers. I mean, exactly that. If you're going quarterly on something like that, or how about this novel idea? What if you planned your maintenance out from the start? What if you took care of a lot of your capital expenses from the beginning? When you bought the property, you went ahead and realized, hey, my HVAC is 13 years old. Maybe we should go ahead and set aside $5,000 to replace that HVAC system in 2 years.
Or do it right now.
Or do it right now and not have to worry about it.
And a lot of times you'll see
you'll
that.
miss those service charges,
Exactly.
right? Yeah,
and a lot of times you're going to see that rental income when you can advertise it. Hey, brand new HVAC system, brand new floors, brand new this. That $1,100 number is usually going to climb from there.
Yeah, absolutely it is. On top of that those days on market, 15 days, we can drop that a little bit too. What if you've partnered with your property manager before you bought the property, and while you're getting everything ready, you're finishing up all the rent ready stuff, you go ahead and start marketing it before it's actually rent ready. You pre-market this thing so that in day one, you already have 15, 20 showings scheduled. They come in there, you have an offer for rent, you've got several applications, completed applications, day 2, day 3. Hey, what are those 2 variables that we have? Maintenance and vacancy? Oh, what if we just cut those down significantly lower, because we're actually working with the best people in the industry at making that. And I don't just mean us, I mean your property managers. Those are the best people to be able to handle those 2 tasks, right?
Exactly. So just for, I don't know if you guys had pens, if you wrote any of these numbers down, but let's take that vacancy number out real quick.
Okay.
Or let's reduce that to 5 days on market and see what happens. So,
okay. If you reduce it to 5 days on market, that vacancy goes down to $15.28 a month, or annualized, it comes down to $183.
Which puts your monthly cash flow at
$198.
Ta-da.
Yeah, ta-da. Yeah, it's so unbelievably simple. Handling this properly is beyond important. Calculating realistic numbers is the way that you change your life from, I am making, say you're the average worker in America, you could make, like 50 grand a year. Is that,
I think that's
annualized income in America?
Something like that, I suppose.
Like that. Whatever it is. And you need more actual annual income to meet your financial goals for success in your life. Oh, well, look at this. This adds $1,500 in your first year. Year 2, that $1,500 becomes $2,679. Year 3, you've added $3,000 to your annualized income. In just 3 years, you've added $7,291.16 to your income. And we haven't even started talking about capital gains. Let's talk about appreciation on your cash flow and property, Christine.
Yeah, so I'm pretty sure if you are watching or listening and you're within a couple months of when this aired.
Sure.
Most of the markets that we have a stronghold in.
If it's 2022, anyways, how about that?
Yeah, if it's 2022 and you were here for 2021, we've had markets that appreciated by almost 20%.
Oh God. So
I mean,
I'm going to interrupt you because I'm going to talk about Griffin, because I've got the numbers here in this spreadsheet. So when I perform a cash flow analysis spreadsheet for people, I put in very specialized market history. So I have the last 5 years worth of rental history medians for that area. And we watched it climb an average of 10% a year. So 795 up to 900 and then up to currently 1100. I mean, like, it goes up, but the actual sales value. So Griffin, and not all of Griffin, because Griffin is a much bigger city than the area in which I'm talking about here. We're talking about a very specific area. It is the downtown section. When you're looking at it on a map, the actual city lines go way further than where the grid is, but we're talking about like the actual overlaid grid of Griffin, right? In 2018, the median sales value for Griffin was $28,200. That is super low. It went up the next year to $36,000 That is a 28% increase. Because when you're dealing with much lower price ranges from the start, that's not even a $10,000 difference, but it's a 28% increase on your money. So when you're starting out in like I said, a C-class area or a transitional area, these numbers get so much bigger because you're starting out with so much less from the start. We got up to 2020, the median was $39,209. In 2021, this is the massive, ridiculous jump. The median price point in 2021 was $71,151.
And look at the difference
that is an
between
81% increase. If you bought this property in 2018, you've already made over $100,000 from this property. I mean, you've made ridiculous money on this property.
While having a positive cash flow.
Yeah.
So I want to skip back to year 2.
Okay.
Because I want to really put it in perspective. Sure. What happens when you have a property that is, good quality, average days on market or below average days on market. You get a tenant in there who is likely to stay for a couple of years.
Usually.
Look at what happens when you take out that vacancy rate, because people want to stay. They don't, you're doing maintenance, you're providing a good product. Hopefully you've partnered with a great management company who cares about the resident experience. So tenant is not leaving. Look at what happens to your cash flow number in year 2.
And also take into account, like in your notes, make sure that, we're looking at the fact that we changed it from 15 days, which is the actual time over there, down to 5, and it jumped up to 195. Year 2, guess what? You don't have to worry about vacancy. It goes down to 0 days because there's a tenant in place. Now your cash flow jumps up to $244.12.
That's pretty nice.
Yeah. Hey, now you're halfway there to your $500 a month mark on this one property just in year 2. Guess what, Christine? If we just followed this path for another couple of years, do you think we can get to $500 a month?
Yes, please.
Yes, please. Yeah. It's because, I believe it was Warren Buffett, and this could be apocryphal and I could be wrong. So, listener, please let me know if this is not exactly correct. But I believe
Don't throw tomatoes.
Don't throw tomatoes at me. But from what I can remember, Warren Buffett had a quote about real estate investing that it was not timing the market. The trick to real estate investing is not timing the market. Buy when everything crashes and it's low and sell once it gets really high, which is a thing that we see a ton of right now. People are trying to time it. I'm going to cash out. But it's time in the market that makes you wealth. There's one way that can make you money. There's another way that can build you wealth, and that is time in the market. The longer you go down this, one of the non-variable numbers is that loan payment. What happens when you start paying that principal down to almost nothing? If you keep paying your principal down and it keeps dropping from $542, you could drop it down. You could refinance it and just make it lower. You can keep going lower, or you could pay it off quicker. There's a lot of ways you can handle that. You get that down to nothing. That adds an additional $500 to your cash flow. That's ridiculous. But even if you don't do that, you keep cutting down several costs. Like you can keep chopping some of these numbers down. The year that you replace your HVAC, roof, and water heater, what do you think next year's maintenance cost is going to be?
Very little.
Very little.
And if you already had put aside, in this case, we're putting aside that $50, let's say you have to do a major or a larger repair on year 3. So if you had, I don't know, let's say $200 in maintenance for year 1, $100 maintenance in year 2. So you basically, you have some money just sitting around waiting.
You've got like $1,600 left in this model right here. You still have $1,500 or $1,600 just kind of laying around in your reserve that you can use to fix that water heater when it blows.
Exactly.
It's going to cost me $1,200. Oh, look, I've still got $1,500 left in my reserve. Talk about planning for your cash flow. That's it. Because imagine you don't plan for that. I need to make $280,000 $80 a month cash flow because I've calculated it incorrectly. And let's say you can't make that number because something happens. You don't plan for your maintenance at all. You don't plan for vacancy. You don't put that in there. And then what happens when, well, now we have an issue? Well, you can't afford to fix it. Do you think your tenant is going to stay in that property?
Nope.
If it's flooded or if the HVAC doesn't work? What if, I don't know, the roof starts leaking? Are you going to be able to hold them in that property? No, when they're going to leave, you're going to lose what could have been a great tenant. You're going to lose income, and then you're back to vacancy, and now you've got maintenance costs because you've got to fix it before you can put a new tenant in there. Because those costs, when maintenance comes up, they don't go away. That cost doesn't go down, right?
Nope.
Like, let's talk about right this minute how maintenance costs just nationwide have gone up because material costs have gone up.
And labor cost.
Absolutely.
And also, there's too much work, not enough vendors.
Absolutely.
So that's another thing you have to take into consideration too. And that's why you have to know you have to know what your money is doing.
Yeah, absolutely. I mean, there's so much of this that is just making sure that you're operating these businesses in the most efficient way possible. When you are working with a high quality property manager, when you're working with us, let's just say it. If you're working with us, the efficiencies that we have to handle these, to plan these out for the future, the way that we increase tenants' rents, like that is a spreadsheet unto itself. That we have an internalized software that increases the rent based on the tenant's performance while they're in the property. It's not just what's their credit score and how much income do they make. Like, we do a way deeper dive than that when we're, screening tenants to begin with. But we screen the tenant all year long. We continue to screen them. Do they cause any damage? Did they pay late? What'd they do?
So anything that you can do to watch over the variable expenses, the better, more successful you're going to be. I think that's the bottom line. That's the takeaway from, what is cash flow, what properties are positive. That's the takeaway.
It is, but I think we're leaving, there's definitely an elephant in the room.
What's that?
And it's like, I can hear it. I can hear it. Well, you didn't talk about variable costs when it comes to property management. Should I pay less for my property manager? Can I talk my property manager into cutting their costs down so that I can increase my number? If I can't change my taxes, I can't change my insurance, I can't change my loan.
So
maintenance, we can do something about maintenance.
Let's talk about
vacancy.
That,
we can do something. Management fees.
So let's say you decide you want to self-manage. What does that actually look like in your cash flow analysis? What impact does that have on your variable expenses?
Do you think that you can lease this property quicker than I can? The answer is just no. It's not even close.
Yeah.
I mean,
agreed.
Maintenance cost, literally maintenance cost. People, because they're not working with a professional. I've watched people try and self-manage because management costs too much. I'm like, that is not I'm paying too much for this, because what you're about to find out is, yes, I've calculated maintenance cost at $50.23 a month because I've factored it in at $602 a year. I'm going to self-manage. And then they make that $50, every month that they don't actually have to go and fix something. They think they're making that extra $50 in cash flow. They think they're getting that extra $77 in cash flow. They're not even factoring in vacancy for the most part. So and then they've looked at my model and gone, well, Jonathan said I was only going to make $198.16 a month. Look, I'm making, almost $300 a month now. All it took was for me to self-manage. And then what happens?
Month 18 rolls around.
And or month 8, Christine.
Yep, month 8.
And your tenant needs to be evicted, which costs a ton of money.
So now you get to throw attorney's fees in.
Oh, God.
Which
And I'm not going to say that we've never had to evict people,
No,
but
of
our
course.
eviction rate is less than 1%. How about that? Mm-hmm. When you talk about things like maintenance cost, what Christine and I were talking about when we were talking about maintenance, the reason that we get the pricing that we do is because we give them more business and we're more efficient than you are.
So I really want to talk about I know we're talking about cash flow, but I think this is one of those big deterrents. This is the objection that we hear all the time. Well, you guys charge this for maintenance. You guys charge this for maintenance. And I really, cheap is not always better. The cost of cheap or unqualified work is way more expensive than the average work order that we have to submit. I mean, I
know that we don't have time to talk about home warranties right now, but they are the bane of my existence.
we're going to do an entire episode on maintenance, and I know what the objection is. We hear it on a daily basis, and I don't mean Jonathan and I mean property managers or in general, even the multifamily space. We hear that all the time. Well, maintenance is this, maintenance is that. The cost of maintenance or poor maintenance is way more expensive in the long run than just paying for qualified individuals to do the job right.
And to take that out of vague terms, what we're talking about when we say that is we're not just saying that like using lower quality materials. No, we're talking about they aren't doing the jobs properly. We have seen it. We have taken over properties. We have done this. And when you walk in and you see plumbing that has been duct taped together because it was the cheapest fix to stop a leak, or a HVAC system that all they have been doing is just putting Freon back into it every time it leaks out instead of fixing the issue. Do you know how much Freon costs every time you come in? Yeah, it's cheaper than replacing the coil, but if you're having to pay $150, which is that'd be super low now, it's more like $300. Every couple of months, by the time it leaks out, $300 times, 4 quarters, you spent $1,200 when it could have just been like a $900 fix if you had done it right.
My personal favorite is when we had an uncle come over, change a supply line that he got out of his garage. Why are we going to pay $70 for a trip charge? That's ridiculous. That's a waste of money. So now we have this supply line that has flooded, I don't know, that floor, the floor beneath it. Now we have massive water damage.
Yeah.
Gets better. Let's not do anything about the water damage. Let's just hope it dries out.
Lay some towels down.
It's great. We'll be fine. Maybe we'll invite Uncle over again to do it.
All right. So are we going to say the naughty word? So mold is one of the naughtiest words in real estate, and in I think everybody's opinion here, because it's mysterious and maybe it costs a ton, and maybe there's health issues. We're definitely going to get flagged for bad words. Yeah, you're right. I mean, illicit tag. We said mold. Sorry. It's such a cost sink. If mold happens, it is so damaging to your overall cash flow.
Well, let's talk about that.
Just want to talk about remediation for a second.
Well, I don't even want to get too much into it because the maintenance one is going to be really fun.
I know.
However, the one thing I do want to say is let's look at that insurance number.
Yeah,
so that insurance number is a pretty consistent number.
Yeah, 15,
usually. Okay, so you have
what is it? 52,817. Sorry.
Yeah, $52. Yeah. Pretty steady number, or should be a pretty steady number.
Mm-hmm.
So let's go back to that scenario. We have our uncle. Mm-hmm. He does a supply line. Mm-hmm. And now we have this massive claim. So what happens to that cost?
Oh, it's going to skyrocket.
Oh, but wait, there's more. So let's talk about the V&C rate. Because we've said vacancy, but in our language, it's called a V&C rate, which is a vacancy and collection rate. Mm-hmm. So now we have our resident.
Yeah.
Who uncle came over, did the thing, and flooded the house inadvertently. And they've been living in this construction zone for a month. Do you think they want to pay their rent?
And do they legally need to? Yes, of course they do. Are they happy with you? No. Are they going to sign a renewal? No. And do they owe you rent? Yeah, they do. I know it's taken a long time to fix it. They do owe you rent, but how likely, even if they're one of the best tenants in the, how many times have you answered the phone? I am not paying rent to this landlord if he doesn't fix X, Y, and Z. And we have to explain it. Your rent is not owed for them to do this. Your rent is governed by the lease. You've got to do that. We're trying to work with them to get it fixed. It doesn't matter what we have to say. It doesn't matter if they know it's going to hurt their credit. They are so mad that you have let this issue continue, and it's not their fault. It's not their fault that you didn't fix it.
So more often than not,
there's a collection now.
There's some collection amount that's going to come from that few $100 that you saved, air quotes, that you saved for maintenance.
Oh, and if we talk about the actually losing the tenant and having to place another tenant, hey, guess what? We didn't talk about the leasing fee. Leasing fees are much more expensive than monthly management, and that's like almost a full month's rent. So if we're talking about now you got to do another tenant because you lost your tenant, oh, that's in this case $902. Ouch.
So you might see a bigger number in your cash flow, or inaccurate cash flow, but ultimately it is better to look at these numbers realistically.
Yeah, absolutely. Conservatively,
and be pragmatic with them.
Absolutely.
I mean, really think about what the cause and effect will be if you make a decision on the variables. And
how about this? Kind of wrap this all up in a nice, tidy bow. Finish everything off. Say goodnight. The thing is this. If you don't know how to accurately come up with these numbers yourself, don't guess. Don't guess and hope for the best. That is not the way to become a real estate investor. That is the way to become a hazard. Have the wherewithal to know what you can realistically calculate yourself. And for the things that you can't, I need you to understand the value of someone that can analyze cash flow for you from real world numbers, actual expectations, and put it together for you to really see it. Yes, you don't actually lose that $50.23 in maintenance a month. Yes, you get it. Set it aside. Set it aside. Let someone that understands how this works do it. We do this all day long, every day, for hundreds of properties. We know where it's going to go. We've done this. And that's the most important thing. If I could say nothing else at all, it's have someone help you with this. If you don't know how to do this, if this is not your full-time job, it is mine.
By the way, this is something that we offered to our clients. This is something that, listen, we're special, but get with a professional who can help you with this. This is actually, it's pretty simple stuff, but it's like bad news is always presented best up front.
Yeah, of course it is.
That's been my philosophy for years. So present the bad news to yourself and look at what your property is doing.
Absolutely. And I think, that's all I really wanted to get to today. Look, hey, thank you again so much for listening. Make sure to hit subscribe, hit the little bell notification. We will see you on the next episode. Thank you so much.